13. Today's blog is titled, What's Good is What's Bad. The improving economic trends is leading to speculation over the change in Federal Reserve policy. What happened last week was we saw a across-the-board drop in stocks, bonds, and commodities. This was all precipitated by speculation over a change in Federal Reserve policy, moving away from our accommodative strategies employed to stimulate economic activity. Last week we did get the most encompassing report card for the economy, the GDP report, which showed a 2.4% gain. If we look a little deeper into the report, the private sector actually is doing relatively well, growing at an estimated 3.4%. However, government contraction is reducing overall GDP, we estimate, by about 1%. Hence, we're growing at somewhat less than what we would normally expect to see in an economic recovery. As we dig deeper into the activities of the Federal Reserve, keep in mind they have two tools that they use to either stimulate or contract the economy. Their long-time tool has been to use short-term interest rates through the Fed funds rate that they can control, either raising or lowering it. And more recently, we know that they've lowered it to just about 0% in an attempt to stimulate the economy after the Great Recession. Quantitative easing or bond purchases is a new tool that they have used during this economic challenging period. And that is one of the first tools they may actually begin to back away from. Let's just see what happened last week. As the rumors of the Federal Reserve moving away from their accommodative policy, the long-term Treasury bond increased rather sharply, going from 1.6% about a month ago to over 2%, to ending the week at 2.1% yield. While still very low on a historic basis, it's been a rather remarkable rise recently. The increase in the 10-year Treasury yield also impacted many other bond substitute investments, such as real estate investment trusts and stocks with high dividend yields, where they experienced losses in much greater percentage than the Treasury market. And then on Friday, we saw a rather sharp sell-off in the S&P 500, with that index ending the day off almost 1.6%. And here we see a chart of the 10-year Treasury yield and the sharp increase over just a short period of time from approximately 1.6% pushing over 2%. And real estate investment trusts were probably one of the hardest hit subsectors of the equity market, as we can see losses greater than 10% over just a short period of time. So a lot of the appreciation that they experienced over several months was all lost in just about a week. The outlook. Until the Federal Reserve clarifies its position as to interest rate policy and quantitative easing, any economic data that's particularly strong may be viewed negatively, as it would provide greater evidence that the Federal Reserve can pull away from their accommodative policies. We do anticipate the U.S. dollar to remain stable to possibly inching higher, which is in the long term very good for our financial markets. Bonds, we do expect the 10-year Treasury yield to climb to about 2.5% over the short to intermediate time period. And that's largely as a result of any increased quantitative easing by the Federal Reserve and improving economic conditions. Stocks may be in for a little rough ride over the next few weeks as investors get comfortable with a potential change in Federal Reserve policy. Although as we get towards the end of the month, keep in mind that window dressing may become more commonplace, as many investors have missed on the rally in stocks year to date and will wish to add to their portfolios before the end of the quarter when they need to report to their clients. Just a quick chart on the currency market. As we can see, the U.S. dollar has been increasing rather nicely over the last few years, and we do believe that trend to continue. Generally speaking, that's good for the financial markets. Stocks, and this is a 9-month chart, a big run up coming off the lows in April to the highs, all-time highs reached a few weeks ago, and now we've experienced a pretty big sell-off on Friday, and that may take a little while to settle down. My favorite chart to look at is a multi-decade chart of the S&P 500 going back to 1994, where we saw the peak in the S&P 500 at the end of the technology craze at around 1550, and then a peak at the credit bubble, a peak at 1576, and now we have finally moved into all-time high territories over 1600. It may take a little while for us to settle in to the supporting the level of 1600 in the S&P 500, but we may be on the verge of a new bull market in stocks that I've calculated could take us up to approximately 2500 over the next 2 to 5 years. So the outlook long term for stocks is still quite good, although in the short term it may get a little cloudy as the investors absorb the significant gains that have been experienced over the last year to two. Thank you for tuning in.